Good morning, everyone. Welcome to this global update for stock markets for the 20th of September. And I guess the most anticipated event that we've seen in the last 5 to 10 years occurred during the week with the Fed decision on interest rates. Would they raise interest rates for the first time in 10 years? In the end, they decided not to, and the market really didn't like that at all. And so the big question now is, will the correction to the downside continue? So that's what we want to look at this week. So let's get stuck into it. But we'll start first of all with a bit of a bigger picture look at what has actually happened. Now, the Fed decision just continues the uncertainty. We've had uncertainty all year because people were speculating when they would move interest rates, and that hasn't changed. We're still in exactly the same position that we've been in all year. Now, pretty much all year, as you know, the stock market has moved in an extremely tight band, very low volatility. We've now moved into a different phase of the market where the volatility is much higher and the market is reacting poorly to news, whether it be negative or whether it is more neutral. So this was probably the worst outcome that the Fed could have come up with from the point of view of stock markets. And it also signals a major change in approach. Up until now, the Fed has been totally focused on the consequences for America only. And for the first time, they acknowledged issues overseas. They acknowledged issues of global growth, of China, of emerging markets, of weak stock markets, and that signals a real change in approach for the Fed. So it'll be interesting to see how that plays out. Now, from my perspective, the correction is not complete. I think the overwhelming odds are that that is the case. And so therefore, a retest of the August lows, remember the crash on August 25th that we had where the Dow was down 1,000 points at one stage intraday. I believe those August lows are now extremely likely to be retested. We also saw the VIX index came off quite a bit, but then it got down to support around 20 and then bounced back up again. That's not really a great sign. It's indicating that that markets are still pretty nervous. And finally, the negative patterns, if you look across all the global stock markets, the negative patterns are there pretty much everywhere. America is the least negative of the charts, and everything else is a degree or two worse than America. So this is not just about one particular country. This is a global pattern right at the moment. And reinforcing that is that we've seen money flowing back into bonds. And if you look at TLT, which is a composite bond fund, it's evident that that money's flowing back into bonds. And almost by definition, that means that money's got to be coming out of stocks because money just doesn't go into the ether somewhere. If it's going into bonds, then it's coming out of something. And that something is almost certainly the stock market. Now, just a bigger picture observation, the actions of central banks since the GFC, you've really got to say at this point in time are failing. In total, if you add up Europe and UK and Japan and China and America, there's been around $8 trillion of stimulus pumped into the world's economy. Interest rates have come off by something like 4% in America, and yet global growth is still well short of expectations. So one can only conclude that the actions of central banks are just not succeeding. And, I'm not sure what the ultimate solution is. So I guess we're going to limp along for a while longer. But that doesn't mean that there aren't opportunities in the stock market. There'll be, in a volatile environment, there's always great opportunities. That's the bottom line. So let's look at American stocks now. The S&P index ended up lower by just 3 points on the week. But certainly Friday's sell-off, big intraday reversal on Thursday, and then Friday's sell-off indicates that we're now getting the third leg to the downside. And last week I spoke about the fact that you often get a three-step process. You get one initial leg down, you get a bounce, and then you get a third leg. And we got a big intraday reversal, which we'll see on the chart, within an overall rising wedge pattern, which is bearish. And then we did get a break of resistance initially, followed by this big intraday failure, and the volume was quite big. So from a purely technical point of view, this is really quite a bad sign. And what it means is that most of the traders have been caught on the wrong side of the market. A lot of the traders were expecting the market to continue to the upside. So that break of resistance, a big intraday spike, and then big volume indicates that a lot of traders got caught the wrong way. And also, markets finished the week with a huge net short position on the SPY futures. So the setup for next week is particularly negative. So I would expect that support, when we'll look at that in the chart in a minute, that support will break. I think that's the only reasonable conclusion that you can come to. So let's look at the S&P first of all. This is the big picture, the monthly chart, and you can see compared to 2011, it's really no different at this stage. 2011, we saw a weak August with a partial recovery, exactly as we've seen here. Then we got a more negative September. So at this stage, it's still playing out exactly as 2011 did, and then we got into a rebound. And certainly that's what the fundamentals would indicate, that this rally is not over. But there's been, in a lot of ways, there's been more technical damage done this time than in 2011, and you've just got to acknowledge that. So let's go back and look at the daily. So we had the big initial plunge, and then we've had a recovery. We got a bounce. That bounce made it to the 50% line, which occurred on Wednesday. So we had then resistance at around 1997. Now on Thursday, you can see the market opened up. It shot up on the Fed announcement, broke through that resistance at 1997 very, very strongly. It shot up there in the space of about 10 minutes. But then a huge intraday reversal, and the market actually finished down, and finished down back within that resistance zone that it had broken. So that indicates a lot of traders had gone long, found out they were wrong, had to reverse their position, and hence the big sell-off on Friday. Now you can see we've got a short-term rising support line that was broken by a minute amount, but nevertheless broken. And I fully expect to see this support down here at 1903. I expect to see that broken. It then remains to be seen whether we see the lows broken at 1865. And then, of course, the next target will be the lows from October last year, which is down around 1820. So they're the key levels: 1903, 1865, 1820. And at this stage, I can't really indicate where I think the market's going to finish. It's just going to be a day-by-day proposition. But this whole setup is, from a technical perspective, is really quite negative. Let's just look quickly at the volatility index. So this is the VXO, and you can see the very brief periodic spikes that we get in volatility. The volatility came off very hard. We got down to 18 on Thursday, and then turned around and went back up Friday. Now the only caveat that I'd put on this is that Friday, once a quarter, there is what's called the quadruple witching day, where you get stock, index, and options futures all expiring together. That always causes volatility and elevated volume. So that kind of clouds the issue a little bit. How much of this was selling due to options expiry, and how much of it was selling due to the fact that traders were getting out of stock positions? We don't know. Next week will give us a lot more information on that, but it's certainly not the greatest sign to see the VIX index jumping back up again. So lots of potential negatives out there. Turning to Australian stocks, the Aussie dollar has rallied. The US dollar was weaker because the Fed didn't raise interest rates, so the US dollar had gone up a bit in anticipation of that. So some of the heat came out of the US dollar. That meant the Australian dollar went up. And that's just a pretty normal reaction, no surprise there. But both fundamentally and technically, I think the overwhelming odds are you're going to see the Australian dollar in the low to mid 60s is the likely outcome over the next 6 months, 12 months. It's hard to say. We've got down to this level much, much quicker than I would have thought was likely. So markets moving far more quickly these days. Now, the ASX 200 index ended up by 100 points on the week, and that's largely just a reflection of the banks, but it is stuck within a wedge and in a big picture downtrend. So there's nothing very attractive about the ASX 200 at the moment. And I think the direction of our market is just about how overseas funds see the Australian market at the moment. So let's take a look at the ASX 2, or we'll look at the FXA first. So this is the Australian dollar. So you can see from the moving average, we're still clearly in downtrend. The price of the dollar is still clearly below the moving average. We might even see a little bit more strength in coming days. We might get up into the 73, 74 cent area, but there's absolutely no reason to think that this isn't going to resume its downtrend soon enough. So if you are trading in America, and you know that that's been my overwhelming position for more than 12 months now, then and you've been looking for opportunities to move more funds to America, then doing so on a bounce in the Australian dollar is to your advantage. This is the ASX 200, clearly a downtrend. We've now been consistently below the moving average now since early June. The moving average is now rolled over, so clearly we remain within this downtrend on the Australian market, so not a good sign there at all. Turning now to gold. Gold jumped $32 on the week, so that was largely about the US dollar coming off, so largely a currency effect. So there are some improving signs for gold, but look, the pattern looks very similar to me to December 2014, and that ended up in yet another failed rally on gold. So I'm not getting at all excited like some people are. I think this is just in keeping with the decline in the US dollar, and I think that is going to be temporary. And also, gold stocks are still not confirming the move in gold at this point in time. So let's look at gold on a weekly time frame. I think the daily, there's probably not much value to be gained there. You can see we've still got this very strong long-term support line that started back in 2006, was also created in 2008. So we're still respecting that long-term trend, but you can see there's absolutely nothing there to suggest that we're going to see a change in gold. We've got a declining, a really big picture declining wedge pattern here. We'd have to get up above around 1280, I think, to get excited about gold. Turning now to gold stocks. This is the HUI index. Again, there's just nothing there at all. Yeah, there's a little bit of a blip, but nothing really exciting about gold stocks as well. And gold stocks are going to lead the gold market, so I wouldn't be doing anything in the gold market as yet. Copper down a little bit, down to $2.38, which is interesting considering the US dollar was also down. So that's net selling of copper. Crude oil was steady from the week before at 45. And as I said last week, it's really quite a brave call to be trying to pick the bottom in crude oil at the moment. There's the spot copper chart. So just to wrap it up, overall, I still have this conflict between the fundamentals of much of the American market. The American economy is doing better than just about everywhere else. it's doing okay. It's, there's not really that much of an economic issue in America, and stocks are doing very well also. So the fundamental picture for most of the American stock market is actually quite positive. Valuations aren't an issue except in a few isolated pockets. So I just don't have an issue with the American market fundamentally. But technically, there's a lot of damage been done by what happened in late August, and sometimes that technical pattern just has to play out. Wrapping all that up, I think a W type pattern bottom is the most likely outcome. I find it hard to accept that we're going to see significantly lower lows, but we might go down to the 1865 area and retest that low. And the other reason too is that investor sentiment is just too negative. You don't get market tops when investor sentiment has been negative for the whole year. And the economic data is just too solid. So those contrarian indicators to me almost negate the fact that we've seen a major top and we're now going to go into a bear market. It's just unlikely. And I think the other thing is too, there's a lot of evidence around on the material that I read that fund managers have de-risked themselves. The selling has been done. Fund managers have moved the position of their portfolios to a level of much lower risk. So it's not like they're still in a high risk position and they've now got to do something about it by selling. I think that process is already done. So, as I said, I've got this continuing conflict between the fundamental data and the chart patterns. And look, we've just got to wait it out. It might just be a few more weeks until we can see resolution of that. So overall, and I'm sorry to sound like a broken record, but look, this is the only way to play this market. You've be prepared to buy quality and value. I think that's the only sort of stocks you should be looking at. You've got to have the courage of conviction at this time of this stage of the market. There are some great buys. There's some fantastic buys. But unless you're really comfortable and confident about what you're doing, then it's often hard to pull the trigger. But the very best investments occur when it's hard to pull the trigger. So this is where courage of conviction is important. And keep it simple. Don't do anything tricky or complicated. Keep it really simple and understand what your game plan is. There's lots of different ways to make money in the market. I have my ways, and they certainly are performing as I would expect. But that's not by any means the only way to play the stock market. You've got to understand what your game plan is and stick to it. Is 2015 really a surprise after the two previous years? We saw very solid to sideways markets in 2013, 2014, well above the moving averages. Markets just don't keep going up forever. So is what we're seeing in 2015 really that much of a surprise? My view is it's pretty normal. You've got to get, after a period of great stock market rise, you have to have a period of catch up. And if we can catch up with essentially a sideways market with a bit of downward volatility, then that's a pretty mild price to pay for the gains that we saw in 2012, 13 and 14. So this is no real surprise. And this is why I've been saying for the best part of 6 months that really you needed to be cautious in this period of 2015. So that's it for this week. There's certainly a lot to focus on at the moment. Just going back to the earlier slide, great opportunities at the moment, but this is where you really need to be crystal clear about what you're doing. You need to be a little bit courageous about your game plan. And if you're not in a position to do that, then I think there's a lot of value that I can add. So there's some contact details for those of you who are non-members. And I look forward to communicating with anyone who would like some assistance. That's it for this week. Cheers.